And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. It's Monday as we start a brand new week. Of course, we're also starting the last half of October, getting ready to wrap up the month. Halloween right around the corner. Yes, put all your Halloween decorations out now. It's now close enough to Halloween. So we were complaining about this in September. Too many were out in September. But now it's time. Good, go. Decorate everything. Anyway, it's all good. A lot of fear and loathing in the markets, of course, over the last couple of weeks. Particularly last week, as the situation between Israel and Hamas has continued to kind of gain steam right now. There were some rumors out yesterday that a ceasefire had been reached. That's been completely denied. Israel, of course, preparing for a ground assault, to further this, hostility. Now, the important thing, though, is that this also comes same time we still have the Russia-Ukraine thing going on. That hasn't slowed down at all. Of course, Israel has now taken the limelight away from Zelensky and the Ukraine. So now all eyes are now focused on what's happening in Israel rather than Ukraine. But nonetheless, that's still going on as well. Obviously, concerns there. This has just kind of been rolling through the markets. And of course, once we just get back to U.S. domestics, right? The economy's been showing some signs of slowing down. Consumer sentiment dropped very sharply in the last report. As student loan payments have now restarted. So all of a sudden, people not so sure about their financial situation as compared to a year ago. That piece of confidence, financial situation versus a year ago, had been improving over the last several months. As soon as those student loan repayments start, that dropped very quickly. Of course, now their financial situation not as good because of that. But the economy showing signs of slowing down for sure. High interest rates, obviously, recent inflation prints have certainly weighed on, kind of sentiment of the markets. And again, when you take a look at sentiment and positioning of the markets, it's been very negative, and it's been that way for the last really 3 months. And again, has not really improved much. So again, kind of no matter where you look, whether it's investor sentiment, whether it's positioning in the markets, whether it's just economic sentiment, take a look at CEOs right now. And of course, we're just really kicking off earnings season in earnest today. More bank earnings out this week, but this week we also have Netflix and Tesla going to be reporting earnings. So we're going to start getting into some of these big, mega cap 7 stocks. And when you take a look at earnings, as an example, earnings estimates are down 3% from the last quarter if you exclude tech and energy, right? So if you include tech and energy, it's basically about flat from last quarter. They really haven't come down much. But earnings estimates are actually 3% lower once you strip out those mega 7 and energy. So again, it's just really a very small group of companies, mostly the mega cap 7 and energy and financials, driving the profit margins of the overall economy right now. So really, when you look below the surface, the strength of the overall economy really isn't as strong as it appears kind of just by looking at the financial markets. But again, we go back to looking at positioning, looking at, kind of overall consumer investor sentiment, still on the very negative side right now. Not extreme fear. We had this little rally over the last, kind of early last week. That took some of that more extreme fear off the table, but still, overall, a lot of concern about where we are and kind of where we're headed to. Here's what you need to know before the bell this morning, though. Markets did come down on Thursday and Friday. So we had this very big rally that ran for about a week, came off the 200-day moving average, ran right in, and we talked about this last week, ran right into the 50 and the 100-day moving average, where those two moving averages are now crossing each other. So a lot of overhead resistance here, and we said that likely, we could see a bit of a failure there, see the markets pull back a bit. That's exactly kind of what happened. Came down, sitting right on the 20-day moving average. Now this morning, futures are a little bit flattish at the moment. Interest rates are up a bit this morning. Stock futures are flat. Dow's up because of energy and what's happening with the material side because of what's happening in Israel, of course. But kind of the rest of the market a little bit flat today. So again, we'll see how the market's open. Kind of need to hold this 20-day now. It's entirely possible that we could come back down and retest the 200-day moving average again. That's certainly not not outside the realm of possibility at all. Particularly given that, we did get, kind of a lot of that oversold condition, had reversed a lot of that oversold condition with that rally. So again, a bit of a pullback here, not surprising, not terrifying, anything else. But that'll potentially set the markets up again for another rally as we get into November and December. And again, we had written an article a couple of weeks ago talking about October weakness, and that it's certainly not surprising if you see a little bit of weakness in the month of October, particularly coming out of August and September. But as we get further into earnings season, if earnings, kind of come in and are supportive, but then once we get into November and December, we have stock buybacks reopening. So again, that's kind of the support for that year-end rally. Again, none of that's actually changed here at all. Markets are kind of doing what they're doing at the moment. There is a bit of a downtrend channel. We do want to pay attention to that. If we do take out the 200-day moving average, then the whole dynamic changes here, at least in the short term. So again, this is a real kind of important range that we're trading in at the moment. Want to keep a watch on this for sure. Again, nothing going on here to be overly concerned about. MACD buy signal is in place here. That's what kind of gave the lift to the markets over the last couple of weeks. And again, positioning is very negative. Again, a lot of fear and loathing in the markets. That's really kind of that setup here. We've got a lot of positioning that is offsides at the moment as we go into year end. A lot of CTAs, a lot of professional managers behind in performance this year. They're underweight equities right now. They've got to get that money allocated on the books. So that's why you typically have this kind of year-end push, and mostly it's just positioning to get into year-end reporting. So again, there's certainly a lot of things, and again, there's, while historical precedent leads to year-end rallies, it doesn't mean it has to happen. There are years that you don't have year-end rallies. A good example of that was 2018. The Fed was hiking rates, nowhere near neutral rates. Market sold off in November and December. You're down 20% over 2 months. So there are certainly periods in history where year-end rallies don't occur. They just occur more often than they don't. So if you're playing probabilities and possibilities, the probability is you're going to have a rally here. So you kind of want to be somewhat prepared for that, but you've also got to be a little bit aware that there's certainly risk in this market, particularly with everything that's going on a geopolitical basis, as well as just really a financial, economic basis. The lag effect of all these rate hikes still sitting in the markets. We're well within the ranges of the lag effect period of whether it's inverted yield curves or whatever it is. There's normally a 12 to 18 to 24 month lag between the time that those invert and the time of the onset of recession. So we're still well within the period where these lag effects occur. But so those lag effects are still sitting out there. That's still going to weigh on economic growth. The Federal Reserve, of course, also coming up at the end of the month. Will they hike rates? Won't they hike rates? Odds are right now that they're going to hold rates pat. And they've really kind of been dropping those hints over the last week with a lot of Fed speakers. Another one out today, kind of saying, the recent rise in 10-year Treasury yields have done the work for them, so they don't need to hike rates anymore right now. So again, there's lots of moving pieces here to pay attention to. But again, we've got to pay a little bit of attention, give a little bit of homage to seasonal probabilities, and kind of give a little bit of specific for that, particularly given the buy signal in place. Short-term overbought is going to work itself off here over the next few days. Then can kind of get set up here for another bit of a rally. So we'll see how the market kind of plays out today. And then we'll keep you up to date as we kind of go along. That's what you need to know before the bell this morning. When we come back, lots more to talk about. We'll get into kind of the outlook for the economy and really talking a little bit about this and fiscal spending and kind of what happens as we head into year end as well. So all that coming up here on the show this morning. RealInvestmentAdvice.com. Our latest newsletter is out, so be sure and go by the website. Get that, RealInvestmentAdvice.com. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at RealInvestmentAdvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So right now, when you take a look at, kind of the markets and, what's going on, this really kind of comes down to, the concern. I shouldn't say it's a concern, but really the, impact of economic outlooks, shall we say. And it's interesting right now because if you talk to most individuals, things aren't fantastic, right? Obviously, once you strip out, kind of the geopolitical stuff that's going on, that's certainly a weight, right? Whether it's Ukraine, Russia, or now with what's happening in Israel. Geopolitical risk, certainly a concern. A lot of articles out today talking about potential for Hamas attacks in the U.S. So, certainly a concern. People very kind of concerned about this. But, when you talk about the economy, people, the vast majority of individuals that are surveyed are concerned about an economic slowdown, concerned about recession, obviously, spending, making ends meet, those type of things. It's inflation. They're concerned about the price of gas, the price of food, price of eggs. Their sentiment is not great. However, if you interview Wall Street, most of them, no recession in sight. Everything is fine. We're just going to have a little bit of a slowdown. It's going to be a soft landing. And, it's a very interesting dichotomy between what the economic data says as well as when you actually talk to people, right? And, this is kind of interesting point is that, a lot of these surveys that are done by the government, whether it, and particularly the employment survey, and we've talked about the fallacies of these employment surveys before, which is that, we call 60,000 people and we say, are you employed? And then people say, well, yeah, I'm employed, or no, I'm not employed, whatever. Then we call the same people for, 4 or 5 months in a row, see if their situation has changed. Then we get a new set of people and we call a new set of people, right? I've never, and I'm 59 years old almost, and I've never been surveyed in my life, right? So, I don't know which households they're calling, but they've never called me. But the point is that in order to have a good survey, right, you need a good participation rate. And if I send out a survey and I need 1,000 responses to have a sampling, right? So so real quick, just in case you don't understand this, these economic reports that we get from the government are mostly surveys, whether it's jobless claims or employment, and again, these are surveys of data. and we take a sampling. So we sample, and for the BLS Employment Report as an example, we sample 60,000 households, and we then extrapolate that 60,000 to represent 330 million Americans. So if I'm not having, and so if my sampling size is 60,000, the fewer number of responses that I get, the less reliable that survey becomes. And over the last really 5, 6, 7, 8 years in particular, there's been a very sharp decline in the number of people taking the surveys. Survey rates have dropped a lot. So the reliability of these surveys, particularly when you're getting a smaller and smaller sample size, is becoming less and less reliable as an official report of government statistics. And these are the things that we're basing monetary policy on. And it's been interesting. We talked about this in the recent employment report. We get an ADP report out, the automated data payroll systems. They provide their data, and they're actually, this is actually a company that's processing payroll, right? ADP. So you would think that they have a pretty accurate picture of what's going on with employment. And again, I've got lots of problems with the way they report their data too, because again, it's really pretty simple to me. And look, I'm a very simplistic person. If I'm a company that's processing payroll, I can simply look at my payroll and say, look, I had 900,000 people that all got jobs this week. I got, another 400,000 notices of people that got terminated. That's pretty simple math, right? But even with ADP, they start doing adjustments and mathematical whatever, right? And just stop that. Just give me a moving average, we're good. But nonetheless, you would think that ADP has a pretty good handle on what's happening with employment. And the interesting thing is there is now a very big negative divergence between ADP and the BLS report. They just don't agree with each other. So what do you take away from that? Is employment as strong as we think it is, according to government statistics? Because ADP doesn't see it that way. So when we're talking about data, and we're talking about the outlook for the economy, what do you believe, right? And again, this is when you come back and talking to the average person, they're not totally convinced that their job is secure right now. They have a job and they're happy to have a job, but if we take a look at the number of job switchers, that's dropping pretty sharply. People aren't as willing to just, get ticked off at their boss and just, screw you, I'm going to go get another job, right? That's slowed down a good bit here as of late. People aren't as convinced that they can just walk out of a job and get a new job. But according to government statistics, we just have a ton of job openings that just, you want to quit your job and change, there's another job for you. So again, big dichotomies between kind of what's happening on the real economy versus how it's reported. But this is what makes it a challenge to manage money and to invest in this markets right now. Most economists expect no recession. Unfortunately, as Bob Farrell once said, that when every person agrees, when Wall Street agrees, something else tends to happen more often than not. And again, from the recession standpoint, right? Remember in 2022 last year, those same economists and Wall Street analysts all expected a recession. It was almost 100% of Wall Street economists were all expecting a recession in 2022, inverted yield curves and the whole nine yards. It didn't happen. And because it didn't happen, now they all think that it's not going to. We're going to have this magical soft landing that we're hoping for. But yet, all the other recessionary indicators, leading economic indicators, inverted yield curves, all still suggest a very high probability of a recession. Timing, of course, is everything. We're not going to have a recession this year, by the way, right? So 2023, no recession. as we talked about before, probably 2024, latter half is probably where we'll start to see it. And by the time that's recognized by the National Bureau of Economic Research, it may be 2025 before they backdate the recession and say, oh yeah, it started in the second quarter, third quarter, whatever it is, of 2024. So it'll be a long time yet before we have that recognition of recession, even though the vast majority of Americans kind of already expect it to happen. There isn't this, this overwhelming sense of prosperity at the moment. So again, this is why it's so difficult trying to parse out all of these different things that are going on. You've got the markets doing one thing, you've got yields doing another thing. You've got economic data on one side saying one thing, you've got economic data on the other side. Then you've just kind of got the overall view of things, right? I'm getting tons of, right now I'm getting a tremendous amount of emails concerned about World War III. This is, what's happening in Israel is going to spread. Iran's going to jump in, and then China and Russia, and we're all going to just be one big mosh pit of World War III. Hopefully not. That would be a terrible thing. Is it a risk? Sure, it's a risk. And you can't deny that. Is it a certainty? No. Hopefully, cooler heads will prevail, and this will resolve itself as it has in the past. I mean, this isn't the first time that Israel and the Palestinians have been at it, right? This has been going on for a very long time, decades. Since 1947 is when this started. And it hasn't evolved into World War III yet. Doesn't mean it won't. And I'm not saying that it will. I'm just saying, there's always the risk, right? We always have to acknowledge there is a risk of something happening. You can't absolutely unequivocally say this isn't going to happen. Hopefully it won't. Odds are it won't. But it's certainly something to consider. I'm not sure that means, going out and building a bunker in your backyard, but it's something worth paying attention to. But again, this is the problem that we have in the markets right now, is that we have a very big dispersion of sentiment in all different directions, which makes it very difficult, again, when you start trying to factor all these things in. What does this mean? What does that mean? How does that impact things? There's so many different variables that the potential number of outcomes are enormous. And trying to factor all those in makes things very difficult on what happens between now and the end of the year and now into next year. This is why we have to pay a lot of attention to what the markets are just doing right now and try to deal with that the best that we can. All right, quick break. We'll be back. More of the show coming up right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Part of the problem of the average American is that we've just chosen to live well beyond our means.
Basically, you can buy anything you want out there on a payment. You need new underwear? Go get it on a payment plan.
Underwear can be expensive. If you buy some Jimmy John's, they're not cheap.
Jimmy John's.
And
Sandwich
the point
underwear?
is,
What is this?
But Tommy John's, thank you.
The Real Investment Show podcast
That's why I just don't wear underwear. It's too expensive anymore.
at realinvestmentadvice.com.
Going commando is going to become a new thing for the poor people.
It's going to be a...
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, right now, it's like, as I said, there's certainly a lot of concerns that are going on and kind of a lot of things happening at the moment. Of course, the big issue is, whether or not we're going to have a recession. That's really what this all comes down to. And everybody's, certainly concerned about that. Wall Street, not so concerned about it. The recent kind of, so the Wall Street Journal conducts an economic survey. They have about 65, 70 different economists that they email on a regular basis and say, what's your forecast for, unemployment and this and that and the other thing, and what's your outlook for recession? And, right now, a recession is no longer in the consensus. I'll just quote to you from the Wall Street Journal right now. Economists are turning optimistic on the U.S. economy. They now think it will skirt a recession. The Federal Reserve is done raising interest rates, and inflation will continue to ease. It's Goldilocks economy, right? It's not too hot. It's not too cold. It's just right. In the latest quarterly survey, the Wall Street Journal business and academic economists lowered the probability of a recession within the next year from 54% on average in July to just a more optimistic 48%. This is the first time that they have put the probability below 50% since the middle of last year. The median probability was 50%. In effect, a coin flip. That's the equivalent of really saying, I don't know. Maybe we will, maybe we won't. But here's a quote from BMO. The probability of recession continues to recede in the U.S. as the banking turmoil subsides and strong labor market resilience and rising real income support consumer demand. That's from BMO. Now, let me contradict that with two other articles from the Wall Street Journal. The Federal Reserve should hold interest rates steady as the U.S. faces the potential for job cuts, though not mass layoffs, the top central bank official said on Friday. Patrick Harker, the president of the Federal Reserve Bank of Philadelphia, said the unemployment rate could climb to 4.5% over the next year, which would amount to hundreds of thousands of job losses, and then fall back to 4% in 2025. So, on one side, you have all the economists saying, hey, everything's fine. Employment's strong. Don't worry about it. You have a Fed official coming out, and this is not the only one, by the way, but you have a Fed official coming out saying, hey, we could see hundreds of thousands of job losses and an unemployment rate rising to 4.5%, which, by the way, would coincide with an economic recession. So, that's certainly concerning. And then we flip on the other side of this, another Wall Street Journal article this morning. This is all in today's Wall Street Journal, right? And as we were talking about before, this is why it's so hard to manage money. All these differing opinions, if you're reading the Wall Street Journal, what do you do with it, right? But here you go. Many of the stocks at the bottom of the market's leaderboard have something in common. They are shares of consumer-oriented companies. More than 24 stocks in the consumer staples and discretionary sectors of the S&P have now set 52-week lows in October. Among them are retailers, such as Dollar General, Target, Kraft Heinz, Conagra Brands, Clorox, and Colgate-Palmolive. Now, let's just take Target and Dollar General as an example. Okay? Set aside the political stuff for just a second. Let's just talk about retailers. Okay? Dollar General, Five Below, those type of companies. Those are at the bottom of the consumer discretionary channel. So as people become more concerned about spending and budgets, they start stepping down the scale, right? So you were shopping at Nordstrom's and Macy's, and then you drop down into Target and Academy, and then you move down into Dollar General and Five Below, right? So you just kind of keep moving down the list. Dollar General's posting 52-week lows, right? That's the bottom tier of consumption. So that tells you that the consumer is a bit more stressed than what surveys suggest. And this isn't surprising to any of us, right? We know the consumer is under pressure. We know that the reason, now that a lot of the stimulus money has run out and those type of things, that the bottom 80% of spenders are having a tough time making ends meet. Yes, when we talk about excess savings, we talk about that's looking at the global, right? It's like we take a look at 100% of the people that we survey, and excess savings are still there, but it's mostly that those excess savings are all in the top 10% of income earners. They have excess savings. The bottom 80% don't. And you see this now reflected in a lot of these, consumer-oriented retail stocks, particularly at the lower end of the scale, starting to see the impact of slower spending. And it's not surprising, right? Higher cost, higher gasoline, higher energy costs, all that stuff, draining the wallets. And again, when you just talk about the issues that impact consumers, they only have so much money to spend. Then they turn to credit, and credit is getting turned off. Companies banks aren't willing to extend more credit in a lot of cases. So we're seeing tightening lending standards across the board. So not surprisingly, we're starting to see the impact on the consumption side. So again, the point of this conversation, though, is that this is why it's so difficult to navigate what's going on within the overall markets. Because on one side, again, you have very optimistic economic analysts, right? These are the smartest people in the room, supposedly, right? These are the guys with PhDs in economics, and they're looking at the raw data, and they're telling you everything is fine. Economists on average, Wall Street Journal, economists on average expect gross domestic product, the value of all goods and services produced in the country adjusted for inflation, to increase 2.2% in the fourth quarter of this year. That is a sharp upward revision from the average of 1% growth last time the survey was taken a quarter ago. So all the smartest people in the room are ratcheting up their assumptions of strong consumer spending, yet the retail stocks are not suggesting that. Now, again, we haven't seen the quarterly reports from these companies yet. We haven't heard from Target and Walmart and these other companies for the latest quarter. Now, we heard from them about second quarter, right? We just got out of that reporting season. Retailers report towards the end of the earnings season. So we heard from them. They all reported slower foot traffic, etc. Has that magically improved in the third quarter? Are we about to get reports from retailers saying, man, we can't believe the turnaround in consumer spending. It's just gone crazy. I'm not sure that's going to be the case. I think we're going to hear much of the same thing. Slower foot traffic, concerns about spending, reduction in staff and wages. I think, and I think the markets are sniffing that out, right? I think investors are sniffing that out to a degree. And that's why you see these stocks trading near 52-week lows. Now, the risk, and again, we go back, as we were talking about in the last segment, the risk with following the economic analyst is that when they all agree on something, typically they're wrong. And I'm going to, fortunately, what the Wall Street Journal provides is all the data on their quarterly surveys. So I'm going to be writing an article for Friday looking at the historical accuracy of these forecasts and say, okay, well, what did they think right prior, in 2007, right? What did they think in 2019? What did they think in, 2012, just before we had the manufacturing recession? What were their attitudes in 2018 before that 20% decline and the drop in Fed funds rates? We'll take a look at how accurate these forecasts have been prior to previous events, depending on how far back the data goes. But I suspect that we're going to find out that they're very late to the party. And the reason is going to be, and this is the problem. If I just take the data and then overlay that on, to a chart of recessions, it's going to look like, that they're pretty accurate. The problem is that the recessions are always backdated, right? 12 months later, we're in a recession going back 12 months, right? So, this is, we'll have to look at the data and see what their views were prior to the dating of the recession. And I suspect we'll find that it's not as accurate as it looks. But anyway, that we'll work on that on Friday. But again, the point here is that you got to be careful with what headlines say. The market has a pretty good sense of what's going on here. And I think the market is going to be right that the consumer and economic growth is going to be a lot weaker than what these economists expect. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, talking about fear and loathing on Wall Street, of course, and, this really kind of comes down to the biggest things that are driving the market is as we kind of talked about this morning, there's so much conflicting data right now. It makes it very difficult to navigate markets. I mean, it's, we all, as individuals, we all tend to gravitate with whatever makes us comfortable in terms of the news. So if you have a propensity to be really bearish, you're focused on Israel and what's happening there, and interest rates and the debt and the deficits, and if your bias is just very negative as a general person, nothing wrong with that. Just if that's your normal bias, those are the things you're focusing on. If you're more optimistic, you're focusing on other things that are more optimistic in nature, right? Stronger consumer spending hopes and those type of things. So it's that's why you have a market, right? You got to have people on both sides of the ledger that are willing to buy and sell. And that's what makes prices go up and down. And eventually, stories will bear themselves out over time. And so, this is why, contrarian investing is so important, is that when you have a very big propensity of negativity within the markets tend to do something different. And, if you take a look at trading flows right now, if you take a look at positioning in the markets as whole, U.S. fundamental long-short gross leverage is up a little bit here in recent weeks. But overall exposure to equities remains at very low levels over the last couple of months. There's been a lot of net liquidation in markets in August, September, and the first couple of weeks of October. So again, if you think about how markets work, right, you have to have buyers and sellers. And, this is one of the fallacies, as we've talked about before. If everybody was a passive investor, if we all just bought an S&P index fund and then did nothing, right, we're just going to sit on it, markets would be flat every day. They would do nothing because there's no buying and no selling. We're all just being passive. This is the fallacy of passive investing, right? We're just going to ride the wave. If everybody's passive, you have no market. You've got to have people willing to buy and sell every day. And that buying and selling is what drives prices. And, we've explained this before about what, in very simplistic terms, is, what drives markets is that you think about two rooms, right? And in each room, you've got people willing to buy or sell. And let's assume that you have the same number of people in both rooms this morning. You have 10 people in each room. So the 10 people that are in the buying room, right? They all want to buy shares, and the number of people in the selling room, same. You have 10 people willing to sell shares. So one of them sells. One of them buys. And so as each of these people transact, we lose a person in the room, right? Because they've done their transaction. So I've got 10 people to sell, 10 people to buy. And so the first person sells, first person buys, they leave the room. Now we have 9 in each room. Now what happens is that as the sellers sell, prices are coming down, right? And there's a number of people buying. They're buying the shares as prices are coming down. Well, at some point, the buyers are going, well, if prices are coming down, I'm going to start putting my bid out there to lower and lower level. And so as they keep dropping their bid for the price, there's a seller there going, man, I can't afford to lose any more money. I'm going to sell. But there's a point to where sellers just go, I'm done. I'm not going to sell at any price lower than this. I'm just going to hold it now, and hopefully it'll come back at some point, right? This is psychology of the markets. But we've now exhausted the sellers. The sellers are not willing to sell at a lower price. And the buyers are no longer, they're exhausted now. They can't get a lower price. So as soon as one of the buyers says, okay, you know what, I still want those shares, but I'll pay you a little higher price for it. One of the sellers that it's left will sell the shares and the price will go up. And then, so now the next buyer over here panics. He's like, man, I better buy it now because the price is starting to go back up. And the seller goes, well, wait a second. If prices are going back up, I'm going to ask for a higher price. And so the buyer says, I'll take it. It's a higher price than the previous transaction, but I'll take it. And so the price comes up, and then the next seller up there goes, oh, I'll ask for a little higher price. And the next buyer goes, I'll take it. And then prices start coming back up. And then there's a point where buyers become exhausted. They're not willing to pay a higher price for those shares. But that's how a market works. That's why markets are driven by psychology, right? They're driven by the fear and the greed, the panic, all those type of things. That's what makes a market work, and you can't have it any other way. That's why prices go up and down. And that's why in the short term, this is why we pay so much attention to technicals. We pay attention to we publish a fear greed gauge every week in our newsletter, measuring, all based on positioning. Are individuals, too greedy or too fearful? Because if they're too fearful, probably you're near a bottom. If they're too greedy, probably near a top. Because that's just the way the psychology and positioning work in an overall market. And right now, that positioning is pretty much on the negative side. Even professionals, professionals sold off a lot of equity positioning. They had below 40% equity positioning in September. That's a fairly low level. In fact, normally, whenever you see positioning at 40% or less by professional investors, that's been almost a perfect mark for bottoms in equity markets. Then they have to position back up. They've got to start adding positions back as prices start to rise. And so we're starting to see, last week, we saw that reversal of that positioning. It's still very low, right? There's still a lot. They've got to put a lot of positioning back on their books yet. But we had just come off of over 90% positioning back in July. So we went from over 90 to under 40 in 3 months. So again, there's this under positioning, this fear of the markets right now that give you a bit more of a bullish tinge to the potential for the markets. That doesn't mean we're going to go off to all-time highs. Nobody's saying that. Just saying that the markets have room to move higher because of this lack of positioning and this kind of fear and loathing on Wall Street that currently exists. We were talking about staples and discretionary. I thought this was an interesting note from Goldman Sachs. Consumer staples was the most notionally net sold U.S. sector on the prime book last week. It's the second most net sold in standard deviation terms behind utilities, which have been driven by heavy short sales. One of the things that drive stocks to really kind of more irrational oversold levels, utilities has been one of those, just been under a tremendous amount of pressure, interest rates going up, so people sell utilities. It's just, that's the way it is. But this also goes to the recent, jump in yields as well. Has been these computerized trading programs that basically jump on a train of momentum. So if the momentum train is higher or lower, they just all pile in, and they're either leveraged long or they're leveraged short. And when they're leveraged short, they just can really drive prices much lower than they would be otherwise. But that provides a great buying opportunity, because when that eventually bottoms and reverses, all that net short has to be covered. All those short positions have to be covered as prices start to rise. And so those computer programs start covering shorts, and it drives prices up. So you can, expect as yields start to come down that utilities and real estate and some of these more interest rate sensitive sectors are going to be huge outperformers, probably next year. Because again, whenever there's something most hated as it is today, those are going to be some of the most loved when that begins to reverse. And it's because of this, kind of this algorithm-driven market that we live in that creates these extremes. The same thing happened in energy when we had negative energy prices. And then you had massive outperformance in energy shares the following year. Just the way things work. So again, Staples short flow has increased for 6 straight weeks. And as this week's notional net shorting was the largest in 3 months, nearly all Staples subsectors were net sold on the week except for retail, led by household products, beverages, and food products. Again, those are all kind of bets on a much weaker consumption number. Again, kind of flies in the face of the Wall Street economists saying everything's just fine, the consumer's booming. So somebody's right, somebody's wrong here. We'll see who it is. But again, this is, when you take a look at headlines versus market positioning, there are two very, very different things that are going on. Now, somebody's going to be right, somebody's going to be wrong, right? Such is always the case. Markets are extremely negative in terms, and when we're talking about the markets, now we're talking about professionals. We're talking about CTAs, we're talking about hedge funds, we're talking about long short managers, we're talking about those guys. They are very negatively biased right now. And they're winning that trade at the moment, right? Because the market's been cooperating them for the last couple of months in particular. So, the question becomes what happens if things reverse in the short term. Now, we're not talking about, next year, right? But Lance, a recession's coming. So, they're gonna kill it because when the recession comes, prices are gonna lower. Yeah, that's, the question though is do they have to reverse first and then reshort again when the recession hits later next year? Because we're not going to have a recession in the last quarter. So balance, right? It's always about the thing. It's two different stories going on. Got to kind of figure out how to thread the needle in between. All right, wraps up the show for the day. Get by the website, realinvestmentadvice.com. S&P futures are up about 15 points right now in the S&P. Dow's up about 158. We'll see how the market trades out today. And we'll be back here to talk more about it tomorrow. Have a great day.